Hi everyone, I'm Ali from Credabl. I'm based in WA and specialise in providing finance to doctors, dentists and vets. In today's episode of the Credabl Difference, I want to unpack the difference between good debt and bad debt and why it matters when it comes to tax. Up front, it is important to note that when it comes to tax, you should always consult your accountant for professional tax advice. For now, let's start with the basics. Good debt is any borrowing that helps you build wealth or generate income. Think fit-out loans, equipment, practice purchase loans, property investment loans, or even education loans. These types of debts are often considered as investment in your future. Bad debt, on the other hand, doesn't generate income or long-term value. Things like credit cards, car loans, or even owner-occupied home loans fall into this category. They may be necessary, but they don't offer a financial return. And most importantly, the interest on these loans is not tax deductible. So, why is this important from a tax perspective? I like to use an example. Imagine you need to borrow $300,000 to renovate your practice. You have these funds sitting in your offset account against your home loan, and you want to weigh up if you should take the money out as a business loan or just pull the money from your offset account. At first glance, the home loan will appear cheaper, as home loan rates can be around 1% cheaper than business loans. But what we really need to factor in is the tax deductibility. For this exercise, I use a home loan rate of 6.5% and business loan rates of 7.5%. On the business loan, you'll have around $22,000 per year in interest payments. Because this is for business purposes, that entire amount is tax deductible. That means if you're on a 30% tax rate, you could get back around $7,000 at tax time, bringing the real cost of interest down to just $15,000 a year. Compare that to your home loan, where your interest equates to $19,000 per year. But none of this is tax deductible, so the full amount comes out of your after-tax income. In this scenario, you are $4,000 better off per annum financing as a business loan, which could be even more if you're on a higher tax bracket. Noting that everyone's financial circumstances are unique, it's crucial you seek the right advice. I find that most financial advisors and accountants recommend for you to pay down your personal debt as a priority and to always check with them prior to paying down any business debts. The same applies for any new lending needs. Make sure you seek the right advice up front. That's another episode of the Credabl Difference. With Credabl, your financial journey isn't complicated. It's designed to be seamless. Making smart choices about debt isn't about saving money. It's about setting yourself up for long-term success. And that's where you experience the Credabl Difference.